A major win for Google parent Alphabet in overtime here as a judge rules the company can keep its Chrome browser but can't do exclusive search deals. This ruling looks like a major win for Alphabet in a case that was originally filed by the DOJ in 2020. What could a ruling like this mean for overall tech, VC, market, tech regulation? Well, joining me now is Paul Abrahimzadeh. He is partner at investment firm 1789 Capital. Paul, for the rest of tech, is this good because maybe the big companies can buy them? Bad because now the big companies can do more of what they want and crowd them out?
I think it's great. Deregulation should be a catalyst for the broader market, and in particular tech M&A. Those volumes could be up 40% this year. This news from Google is a further indicator that a lot of the companies in the private market that we're backing and underwriting to an IPO exit may end up being taken out through M&A. Deregulation is going to be a catalyst that we think further drives both economic growth as well as EPS growth across the S&P and the NASDAQ. So
you're not concerned that the Trump administration might be less deterred than previous administrations by the prospect of a court loss because they can make it hard on these companies otherwise if they really don't want them to buy up smaller firms?
Generally speaking, stepping back and allowing corporate America to operate in a way that drives shareholder value we think is a good thing. And we think increasing M&A activity across the tech sector as well as other industries is going to be a positive both for valuations as well as exits. This is a market that has suffered from a lack of DPI, so the distributions versus paid-in capital across the venture world, growth equity and private equity, has really been challenged over the last decade aside from that 2-year period in the pandemic. So opening the spigot for M&A activity as well as dual track processes with the IPO market reopening showing lots of strength with recent deals. Overall, that's a real catalyst, we think, for the equity market and for capital formation.
Is that going to close this valuation gap that we've seen between private companies and what happens when they actually come public? I mean, Klarna could be an example of that. When it was looking at first going public, it had a valuation up here. Now it's got a valuation more down here.
What's interesting is there's a delta between where companies are pricing at IPO and then seasoning as a fully distributed equity. What we're seeing now is companies pricing at attractive valuations, but then trading very rich in the secondary market. You don't need to look further than the recent IPOs of Circle and Figma and Bullish. These are IPOs that are trading up 65 to 300% in the aftermarket. IPOs on average are trading up plus or minus 50% day one in the tech sector year to date. So exceptional demand in the public equity market for high growth stocks. Why is that? The highest growing, fastest growth public software companies at best are growing 30%. In the private market, I look at our portfolio at 1789, most of our companies are growing 50 to 100% at scale. So from that perspective, we think that it's not surprising that companies are trading rich after they go public. Those three companies I mentioned are trading at 20 to 30 times forward revenue multiples, well in excess of the highest segment in public software. So we see that correlation between growth and valuation multiples evidenced in the IPO market.
Back to this Google ruling, how does it change the next conversation that you have with the founder?
I think M&A is going to come more into play as you see large caps being given the freedom to pursue their growth plans, whether it's organic or inorganic. The fact that the government's not intervening at every step to try and curb that growth is a positive, I think, for the founders that we're speaking to. Again, most of them are happy to stay private, but I think they're going to get pressure from their boards to explore methods of monetizing, whether it's IPO or M&A, both of which have been closed for the last 4 years. So you're opening the menu of options for founders where they frankly were forced only to finance themselves in the private market and stay private for longer over the last 4 years.